Good morning, everybody. Thank you, Andrew, for getting us started. Great to see everybody here, our Canadian friends from up north and everybody else. I want to thank Deluxe, really a pretty special company who, obviously they're not just supplying us with high security checks and pens and envelopes and antivirus. They're also taking the time to educate us on business security and have really become the portal for small business security. So thank you for hosting this, Deluxe. I appreciate it. As Andrew said, I'm John Sileo. Primarily, my role is I speak around the world on how to protect your business's privacy, identity, and reputation. A lot of that is digital, but also in the old-fashioned ways as well. I unfortunately also happen to have some personal experience with firsthand experience with friendly fraud, which is our topic today, or also known as insider fraud. We'll talk about that as we go through the webinar. I'll use that kind of as a framework. And to begin with, what is friendly fraud? Well, it's where somebody that you know takes advantage of you. We're talking about the business side today, not about the personal side. That does happen. Identity theft committed by friends or family members, acquaintances. We're talking about the business side. And from all of the experience that I have been through personally, I have come to learn that friendly fraud is a lot like a bad relationship. Have you guys ever been in a bad relationship? I'm sure that most people at one point or another have. And the point here is fraud can happen at any stage of a relationship. And I don't use the relationship metaphor lightly. It's not a casual comparison, because fraud by definition is something that takes advantage of a relationship, and it shares many characteristics with a personal relationship that you would have. So I'm using that metaphor, which is not always perfect, but it's as a framework to think through these issues of how you protect yourself on fraud. So how is fraud like a relationship? Number one, it generally takes you by surprise. It often starts off too good to be true, and that's because, of course, it is, if it's a bad relationship. And third, you often end up in court and out of money. Fraud is a type of relationship that you don't see coming. You don't expect it, you aren't prepared for it, and oftentimes it has huge financial costs to your business and huge personal costs to your business. Now, there is a difference between personal relationships and business relationships, and I don't want that to go unnoticed. Business relationships always have a more specific purpose. They are ultimately, their goal is to serve a business relationship's goal is to serve a need and to make money, and hopefully in ethical, helpful ways. Personal relationships are broader than that, and I want you to keep that in mind as we go throughout, because it's not a perfect parallel, but if you start to think of fraud as a relationship issue rather than just as a crime, you'll understand it much, much better. So before we go into a relationship, we actually have exposure. In a personal relationship, that might be that we go out and are looking for a relationship. And we, before we get into that relationship, whether it's, in a business way, we're hiring a new employee, potentially fraudulent, we're watching an honest person in our business turn bad, maybe we're even going to commit fraud ourselves, which is part of the equation. Before we get into that, we come to the table with beliefs that expose us or put us at risk of fraud before we have ever even started it. An example is the belief that all human beings are good, or that human nature is good. And yes, that happens to be the case. But it's the exceptions to the rule that mean that we have to be a bit more discerning, a little bit more careful applying that, because while it works as a general rule, it doesn't work for specific people. Take my business, for example. Sileo Computer, which is a 40-year-old company that I took over from my parents. And many years ago, we were struggling just to keep up with the big box stores. We were a small computer company, and heck, direct sales like Dell and the big box stores were eating our lunch. So we were looking for a new date, a new business relationship. We wanted to find an area to expand into. And this type of blind exposure, this type of desperation, ripens you up for deception, just like it would in a relationship. And the answer isn't that you can never be weak, you can never be vulnerable, put yourself out there. What you need to do is recognize when you are in this position of weakness, and then drastically heighten your awareness and know what it is and when it is that people will take advantage of you. This could be when you're desperate to hire a new employee as a small business, when you're in need of capital funding, when sales are down, when you're in the midst of a technology mess and you need help to get out of it. Those are all ripe points for fraud. How lucky were we to find Doug, the business partner that we took on because we were in this position? We weren't very lucky. We started up a internet software spin-off company with Doug, who was my a rock climbing partner, and it was really this belief, this exposure before going in, this belief that humans are basically good, and not looking at the specific circumstances that caused us some real problems. And that brings us to our first secret. We're going to talk today about 5 insider theft secrets. These are the things that you don't necessarily think of when it comes to fraud. And the first secret is that your denial exposes you. Your denial exposes you. Business owners, and particularly small business owners, have a series of beliefs that aren't just kind of misdirected, but they actually attract and encourage fraud inside of their business. In fact, it happens at all levels, not just at the executive level, but it happens to managers, and it happens in these coworker relationships that we have. A lot of times, coworkers are committing fraud against us, against the business, and we don't detect it. When I talk about denial, there is something we call the destructive dance of denial. We've got the ostriches sticking their heads in the proverbial sand, not looking at what they should be looking at. And there are 3 basic parts of the dance of denial. Number 1, we say to ourselves, you know what, it's not going to happen to me. It's not going to happen to me. For whatever reason, I don't need to be thinking about this. Now, the people who are on this call obviously don't have this problem. You are here thinking, you know what, it could happen to me. I need to learn about this. Good for you. It's the other people who didn't make it to this that are actually at a much greater risk. Number 2, we're too small to target. We're too small. I can't tell you how many times I hear, you know what, why would they target me? We're too small. And the final one is, hey, I trust that person in a position of power. They wouldn't dare do that to us. How wrong could we be in these? Almost every case of fraud has these same belief patterns, the same aspects of denial. And if you hear yourself uttering one of those, this isn't going to happen to me, we're too small, that person wouldn't do it, that's your first red flag that you are actually at higher risk because of your exposure belief system that's already in play. By the way, before we leave that slide, ostriches don't actually bury their heads in the sand. That's a fraudulent claim, and are all the pictures that portray that. So let me show you how wrong these 3 beliefs are. Number 1, 5% of an average business's revenues, so that means your average business, is lost to fraud every year. So 5%, you think, that's not that much. But listen, you can't get a CD that will give you 5%. You can't make an investment that strategically every year will give you 5%. And yet, fraud can be avoided fairly easily with some prevention. You have an immediate 5% return on your investment every year by taking care of some fraud. And the outlay in cash in investment is small. Now, the median loss by a business is $140,000. $140,000, that's quite a bit to a small business. My business ended up losing about $300,000 to this case of insider fraud that was brought on us by Doug. But it's not just me. It's not just, a single small business point on a graph. Small businesses, in fact, are more targeted than medium and large businesses. It's kind of a stunning fact. All of the figures I'm going to use today are the best figures in the industry. They're provided by the Association of Certified Fraud Examiners. So people who spend, they have no profit motive. They spend their time researching this. And look at this. In companies of less than 100 people make up roughly 30 to 35% of all of the fraud. And when you add in 100 to 999, still small to medium-sized business, it's a major portion of the fraud. Here's why small businesses are more targeted. Number one, we as small business owners have fewer resources than our larger counterparts, right? We don't have fraud departments. We don't have IT checks. We don't have the same controls. Number two, we have less effective fraud controls. We don't have the time or the money to spend on the same types of controls. And finally, fraudsters know that we have less likelihood of prosecuting the suspects, right? Because we don't have the money, we don't have the time, and that actually encourages more fraud. If you just think about it, if you wanted to commit fraud, would you go to a small company where you have access to everything, or a large corporation where everything is compartmentalized, it's overseen, and it's investigated? And that's how the fraudster is thinking. Now, here's a shocker right here. Not only are small businesses more likely, but they're impacted disproportionately. The average small business loses between $140,000 and $200,000 per case, whereas everything above it is almost lower than that, meaning when a small business suffers, they suffer harder than, in raw dollar terms, than a business with 10,000 plus people in it. We are disproportionately affected. The problem here is, of course, we can't absorb the loss like they can, like a medium or a larger business can. The cash flow ultimately kills us. And that's eventually what my business and the association to Doug and fraud did, is gave us such cash flow problems that it pretty much killed the business. And here, I trusted this person, right? I trusted this partner that I had taken on. And that brings us to the third point. Most fraud is committed by a trusted member of the team who's been there for more than 5 years. You think you don't know them, or you think you know them, you think you can trust them. The opposite is true. The greatest lie we tell ourselves is that a certain person couldn't possibly defraud us. We trust them completely. In the second secret we're going to go through, we're going to look at the triggers that fraudsters use to manipulate that trust. But for now, just understand that an excess of misplaced trust actually encourages fraud, as the perception of risk is much lower. We don't think it's going to happen. So Doug was my rock climbing partner, and what that means, and a friend before we got into business. And what that means is that I had already made a decision to trust him with my life at the other end of my lifeline. And I'll be very honest, my decision to have him belay me on that rock climbing line was based on nothing more than a mutual passion that we had for rock climbing. It wasn't based on anything substantive, like years of knowing each other. And there's a great example of how we make personal trust decisions very different from business, and we'll go into that in more detail. When we took Doug on as a business partner in our new venture, my dad, who was part of the business then and actually is now part of the new business, the speaking and authoring, he imparted some wisdom that might have saved us a ton of the trouble we went through. He told me, and in fact he told Doug there in person, that he wouldn't fully trust a business partner until they had proven themselves for 5 years, all right, for 5 years. The interesting thing about that is you can't just think about it in terms of time, and here's why. Number one, there's these caveats. In this world, we're always connected 24/7, rapid-fire decision-making, we're constantly on. Sometimes you don't have 5 minutes, let alone 5 years, to determine who to trust. You might make a $10,000 online purchase in a matter of minutes on a site that you've never purchased from before. Trust has fundamentally changed in the digital marketplace, and it's no longer about who we trust, which it kind of has been in the past. It's about how we trust. And as the chart shows, much of the fraud is perpetrated by employees that have been there longer than 5 years. So that alone, the time they've been there, doesn't solve the problem. We're going to talk about that in secret number 3. But for now, don't get yourself trapped into thinking that knowing someone for a long time guarantees your safety. And finally, when you say that someone has to earn your trust, you have to make sure that you follow through with verifying that they are trustworthy. My father said this, it takes 5 years, and then we took very few concrete steps to verify whether or not Doug could be trusted. Someone doesn't earn trust alone with time, but with a kind of a gradually relaxed control of these important assets inside the business, and with constant oversight, which we're going to talk about in step 4. So it's not just enough to say that someone has to earn trust. You have to put controls in place that let you know whether their trust balance is positive or negative. And this is really where business relationships are completely different, a completely different ballgame than personal. You have the right and you have the responsibility to verify trustworthiness. When you enter a business relationship, you have to have an acceptance. Number 1, fraud can happen to you. Number 2, your business is exactly the right size. Number 3, the fraudster will be someone you trust. That's the definition of inside fraud, of friendly fraud. And number 4, prevention costs way less than recovery. If you can see those things now, if you can admit those and accept those things to yourself, you are on the first step, the first secret to preventing fraud. The second phase is courtship. This is where you get to know someone. You're not sure if you're if they're the right one. You get to know them, the employee hiring process, before you partner with someone, before you give a vendor a lot of trust. This is the getting to know, the dating stage, and it's when you can detect a certain amount of fraud coming on board. One of the best indicators that someone is going to defraud you is that they've done it in the past. And the best way to determine that they have this manipulative history is to use tools that you've probably already been exposed to as a business person. Now, before I switch to that slide, I want you to know that in this courtship phase, in this getting to know phase, the best thing that you can do up front is to tell them on the first date, to tell them the minute that you are interviewing or meeting them, how rigorous you are going to be with implementing these tools, with taking a background check, with checking their references, reference verification, with doing some on-the-side do-it-yourself research. When you let them know that up front, number 1, it scares away potential fraudsters. Number 2, it makes it okay when you actually go through with it and do these things and take these steps. I would bet everybody on this line has thought of, maybe even performed background checks, they've verified references, and they've Googled somebody. Here's the secret. Bad habits attract fraudulent behavior. Tell the truth. Do you actually take those 3 steps we just talked about? Have you verified the integrity with which you take them? Did we do a background check on Doug? No. Did we aggressively check his references? No. Did we perform any outside research? No. Why? Well, it was a business partner. We were taking it on our gut instinct. Our early gut instinct was, okay, it's probably okay. We better watch it, but probably okay. And by the time we had figured anything out, we were too deep into it to change that decision. Bad habits attract fraudulent behavior. Number 1, background screening bad habits. First of all, most people on this line, I hate to say it, don't use background screening. They don't do any type of screening. The answer, use an employee screening service consistently. It may cost a few $100s to do it. It's totally worth it. It would have saved us hundreds of thousands of dollars. Number two, your screens are not EEOC compliant. Listen, you can't just run a background check and discriminate anymore because somebody is a criminal. You can have a criminal record, and there's no right to use it in a job interview acceptance process if it's not relevant to the job. So you have to learn these EEOC rules and screen properly. The third thing, which we did, you explain away negative findings. You find things in their history that make you pause, but because you need this person so badly, you continue forward. The answer, of course, you have to implement higher standards for employees, particularly with access to accounting or financials or in a technical or leadership role. It's not good enough to simply have these rules in place. You have to act on what you hear. The second bad habit, reference verification. You failed to verify a candidate's references. And as you read through those, I'm going to illustrate them with a story. One of the partners we use for hiring audits to go in and check the security is a human resources specialist who is a secret shopper. She goes in, her name is Nora, she goes in and applies for jobs inside of companies like yours in order to pinpoint all of the weaknesses and loopholes. So Nora was doing a hiring audit of a company in the past couple of weeks, and she set up 4 disposable cell phones and created an identity that belonged to each one of them, which she taped, the name, the company, the position in the company, taped it on the back of the phone so that, in other words, the character she was playing, the reference she was impersonating was on that phone when it rang. She then applied for jobs at that company using those references, and here's what she found. And by the way, it wasn't just in this one case. She found it over and over. She's done hundreds of these. Of the 3 jobs she applied for, only one of them called any of the references. Number 2, of the one job that did call one of the references, they only called 2 of the 4 references, not all 4. On those 2 calls, Nora answered using her own voice, which she had used to apply for the job. She gave a positive review of one of the calls and a negative review, meaning she said to this person, I couldn't imagine hiring them. I don't know why you would want to hire them. Well, you know the punchline. She got the job. They never even called the 3rd or 4th reference to see if the person was good or not, to kind of break the tie, and she got the job. Listen, I know reference verification is time-consuming, but not in proportion to the amount of money that you will pay the candidate or in the amount of fraud you'll discourage by asking aggressive questions. In a side note, years after the fact, I asked a man who could have served as one of Doug's references what they would have told me had I ever even asked for an opinion, which I didn't. And he told me that he would have said, I wouldn't be comfortable being in business with Doug again. Enough said, right? That right there should have triggered, if I would have been listening, much deeper research had I only listened, not just to my gut, but to what he was saying and acting on it. The third is do-it-yourself research. A lot of companies don't use the internet tools out there. Facebook graph search, which is newly out there and will reveal everything on everybody in Facebook. It's terrible from a personal privacy side. It's phenomenal from a research side. Googling their name to see what's happened in the past on them. Checking out their professionalism on LinkedIn. You can link into them and see who they're connected to. Reading their Twitter feed for comments. And utilizing research services like Spokio and Tellius, all of the things that kind of violate our personal privacy from a business standpoint are tools that we can use to get to know them. Heck, you could hire, literally as a small business person, you could hire your 14-year-old to conduct research for you. You give them a name, I guarantee they will come up with what that person has been up to. Make sure you don't believe everything you read online, as a side note to that. You have to verify the online findings with the candidate and let them explain. There's a lot of mistruths out there. There's a lot of fabrication, a lot of fake identities. Don't just take what you read online as fact. Okay, to summarize, the due diligence. The solution here is implement background checks on all employees, particularly that have access to cash or credit or data. Number two, verify that HR managers, that the person doing the interviewing is doing proper reference verification. Make sure you're utilizing the public tools like Facebook, LinkedIn, and Google to learn more about their character. These are fantastic, fantastic tools. So what happens when you're taken by someone's magnetism? You're sucked into their game, so to speak. Well, you are setting yourself up for a tempting fatal attraction. This, of course, is Glenn Close from Fatal Attraction. How much would Michael Douglas's character have paid to have done a simple reference check with Glenn Close's past boyfriends? Of course, I guess they were all dead, but anyway. The average time to detect fraud is about 18 months. So that means that the damage after 18 months, believe me, it's considerable. And it brings us to those cases of fraud that can't and won't be prevented in the hiring or courting or dating process, like that in Fatal Attraction. They need to be detected in action. So we actually have a lot to learn from the techniques of Glenn Close and Fatal Attraction. There are trust shortcuts that frauds, that scammers and manipulators, that they use to speed up the gaining of our trust. They flatter us and give us gifts, act like we act. I never want people to take generosity and kindness for granted, but if your gut says that it's too much, I want you to take a closer look. Doug, our business partner, radiated these fraudster warning signs. Number one, too good to be true. If someone or the situation they put you in is too good to be true, it probably is. To have him show up on our doorstep when we needed it so badly, too good. Too eager to please. If the person is too eager to please you, if they're going out of their way, maybe it's with overly generous gifts. At one point early in the relationship, Doug bought a $70 belay device for me. So literally, he's holding my life, 80 feet in the air as we're rock climbing with this belay device. And my wife said to me, "That's just weird. There's something wrong with that." And she actually sensed early on, that's kind of weird. He's your business partner. I mean, you're making money together. Next one, fourth, person frequently strokes your ego. If you feel like you're getting too much solid feedback and not enough critical feedback, that's a red flag. The person tends to like exactly what you like. They're a chameleon. When you pick up something, they pick up something. You read a book, they read a book. Another one is they want to control all stages of the process, generally inside of the business. They don't want your hand in any part of the stage. They do a lot of work off-site. They're working at night. They're working in the office when you're not there. That's a red flag. These people tend to not take vacations because they're afraid that the fraud will unravel when they're gone and you're taking over their role. They show a change in behavior. And in our case, there was radical changes in behavior, kind of a manic-depressive change that should have warned us. And they're overly protective of their territory. Doug, without question, ingratiated himself. He made himself kind of a brother of mine, a member of our family. And I have to say, I don't think it was devious. I don't think he was doing it because he was planning on defrauding us. And we'll get into that in the next secret. I think he did it out of guilt. I think, in essence, he was buying our forgiveness in advance. So don't think that they're doing this just as a setup. They could be doing it for a host of reasons. And that, of course, takes us into the partnership. We're now in a partnership. At some point, you enter into this partnership where you depend on each other in a day-to-day manner. Now, it may not be healthy, but a partnership does signify a certain amount of trust between the parties. Why don't most business owners see the fraud coming? Because we think that the people who become fraudsters are bad. But in effect, 87% of frauds are good people who make bad choices. They have a clean employment history. They've never been convicted of a fraud-related offense. They've never been terminated by a previous employer for fraud. 84% never terminated before. They have a dark figure behind them, a monster standing behind them, pressuring them to make bad choices. Most people who commit fraud are either under pressure, feel underappreciated, or perceive that somehow management behavior is unfair or unethical, and that they are owed something that they're not getting. In our case, it was that Doug had a dark secret, a second life that he needed to fund without detection by his family. You got to look at that dark figure behind it, the pressure. Lance Armstrong, let's take a quick side note, and the fraud he committed on all of us by winning 7 races by doping. Lance was obsessive with controlling the narrative of his life, was a quote in Sports Illustrated, with how the world viewed him. And research has shown us that it's not about bad people, it's about bad decisions that are made under immense pressure. It's, in this case, a professional cyclist whose career was almost destroyed by cancer, but you know what? He didn't want that to be his legacy. It's your accounts payable manager getting divorced and fearing for her financial security, your inventory person who has to put their kids through college. In our case, it was a business partner who led this double life. They generally have this in common. They have a great need that begs to be fulfilled, and then they see an opportunity. They see an opportunity inside of our businesses to skim some cash. And that low-hanging fruit, it's too ripe, it's too attractive to ignore, and they begin the process of telling themselves little, minute lies, just a little bit of cash, just this one check, just doping for one race will get me back in the game, and then I can quit. That brings us to the third secret of insider theft. Need plus opportunity equals corruption. Listen, fraud isn't personal. They aren't going after you. They haven't targeted you as an individual. They are taking advantage of an opportunity that exists inside of a business and marrying it to a need that they have. It's taken me years, really, to realize that Doug didn't commit fraud because of who I am or who my family was. He committed it because he had this desperate need, and he saw an unprotected opportunity in our business. So the goal, obviously, is to either eliminate the need or eliminate the opportunity. And we do that with early detection. Number one, if you can understand the needs and pressures that motivate fraudsters, you will detect it very quickly. Number two, if you train your staff and managers and executives to recognize these needs, these behavioral motivations, they will detect it, and that becomes very important down the road. Third, if you understand the fraud opportunity hotspots, where does this stuff happen? And fourth, if you train your managers to detect those hotspots, everything gets an awful lot easier. Here are the behavioral warning signs. Again, these are the need warning signs that have been identified by the Association of Certified Fraud Examiners. And if you look at the top 4 or 5, you start to see some patterns. Living beyond their means. They're buying things that, hey, your job shouldn't pay them. They have financial difficulties. Unusually close association with vendors or customers. Again, they're kind of overboard in their kindness. Or that last one, control issues, unwillingness to share duties, or in Doug's case or in Lance Armstrong's case, they want to control the narrative. They want to control what people think of them by achieving this. When we're done with this webinar, I think Deluxe is going to make these available to you, very short time frame, these slides. You should go through and think through each of these warning signs individually. They are incredibly important. There are 9 opportunities that make up, oh, sorry, I should have blown that up so you can see them better. Anyway, we'll get you those slides. There are 9 opportunities, types of fraud, 9 types of fraud out of hundreds that make up 87% of small and medium business fraud, right? 9 types. You need to sit down. When we're done, we can't go through all of these now. You need to sit down and read through every one of these because you're going to start to recognize where they would happen inside of your individual business. We probably have 500 different business types on this webinar, and I can't go through each type for each business. You read through them and you take a look at them. And one that I want to point out here is check tampering. Listen, we're on a call sponsored by the premier high security check company, Deluxe. And I want to let you know, not just as a product of insider fraud, but external fraud, that check tampering is one of the most common, easiest to solve, least expensive solutions that you have. So, you know, obviously, Deluxe has got high security checks that solve this type of fraud. Take a few minutes when we're done here, read through these and understand what makes up 87%. I want you to also be aware that there's a portion of fraud that does not occur in these numbers. None of the numbers take account of employee data theft because it's not a financial theft. It's the theft of your customer list or your intellectual property or something that's hard to quantify. And yet it is a major portion of theft that goes on. They pop in the USB drive and take away your customer list, which they sell to a competitor or online. We know that about 40% of individuals who have left a company, so these aren't just people who are defrauding the company knowingly, 40% take a proprietary company data list or database with them when they leave. They mail it to themselves, they take it on USB. That's a lot. That's a lot of your data leaving. And so things like user-level access controls, logging out of sensitive files, need-to-know controls, those are areas you need to think about in terms of fraud. Our next stage. So we've moved through the partnering stage, and now we get to inattention. You know, once you've been together a while in a relationship, it's easy to get complacent. You base you predict people's future actions on their past track record. And while that might be okay with friends or family, it doesn't work quite so well in business because of the whole need-opportunity equation. The opportunity and the need might not come up until they've been employed for 10 years. And the playing field is always shifting in a relationship, and you need to keep in touch with it at all times. So that lack of attention, the secret there is a lack of conspicuous controls that condemn you. This is where, again, where a business relationship is different than personal. In a business relationship, you get to put controls in place to increase the chances of ethical behavior. You can't exactly put a video camera in your spouse's watch or their purse or wallet. Well, I guess you can nowadays, but you would destroy the trust of the relationship if you did that. But in business, those type of controls are not only expected, but if they're reasonable, they're also respected. So putting these controls that we're going to go through into place is a great start. Number one, you need to build a friendly, ethical culture that makes it a hard place to cheat. These are all tools of deterrence. This is if there's a fraudster, possible fraudster, an opportunity in need, you're going to convince them this isn't the place to do it. And an open, ethical culture is exactly that place. When you practice the ethics you preach as a business owner, I can't tell you how many times we hear, well, he did it or she did it, so why is it wrong? Listen, you're setting the example for your company. You better be ethical or they're not going to be. 3, don't just implement the controls, advertise them. You've got to advertise them, and you do that through training sessions, and you do that in other manners that we're going to go over. And finally, in deterrence, I want you to follow these 6 anti-fraud best practices. Number 1, give them a whistle, right? You have to provide a convenient means to report suspicious activity. You need a tip jar that is locked that people can say, listen, there's something going on here. Utilize hotlines, tip boxes, or even an online form that they can submit. Make sure it's available to both internal and external sources. Our fraud was discovered by one of our clients who found out that Doug was defrauding them. External sources, vendors, people who know you, customers, that's a major way of getting tips. ensure anonymity and confidentiality. Listen, you can't have these people thinking that they're going to be found out if they put a tip in. It just won't work. And you have to enact and emphasize an anti-retaliation policy. If somebody reports it and people find out, there can be no retaliation against them. Why do we focus so much on tips? Because 50% of all occupational fraud is detected by a tip. It's your number one source. When you make it easy and anonymous and confidential, you are going to hear about fraud in 50% of the cases from somebody else. Number 2, perform conspicuous, unexpected fraud audits. Here's a statistic that will, it shocked me. I assume it'll shock you. Only 3% of fraud is detected through a fraud audit, right? An audit with accountants designed to catch fraud, which means that a real fraud audit for most of us isn't probably worth that 3% chance. So what I recommend is what I call a conspicuous fraud audit. It is an event where somebody comes in and aggressively questions the hotspot areas, probably an accountant, probably somebody with a fraud background, and asks the right questions. It's like the alarm signs, and that's why the picture is the alarm sign. You're not actually buying the alarm, but you're putting up a legitimate sign that says, hey, we've got these fraud audits. They may not be in-depth, but nobody else knows that, and that's the key to it. If you're going to do this as a small business, I mean, obviously you should actually have fraud audits performed if you can do that. But I find too many small businesses who don't do that. At least have a minor one performed and make it really visible. And believe me, only you and your accountant, your fraud accountant, are the ones that know that this is going on. Nobody else gets, know that it's a minor audit. Everybody in the business should know you're doing it. Next, add ethical conduct language to your conditions of employment. If you don't have an employment agreement that talks about the fact that it's wrong to commit these crimes, you have a major, major problem. You have to let people know in language, listen, it's wrong to do this, and you frame it in that language. Separation of duties. Listen, Doug had access to accounts payable and accounts receivable. When you do that, it's easy to make phony invoices and to pay those invoices. If you separate duties and you rotate duties in these hotspot areas that were listed on that 87% slide, it makes it really hard to commit fraud. They need patterns. They need time. They need to know how it works over and over again. So separate those duties, and rotate the control. Implement targeted fraud awareness training. Statistics show us over and over again that training reinforces the ethical culture. It shows them that fraud hurts everyone, not just the person doing it. And it reminds people that they're being monitored. And it teaches the people inside of the business how to detect fraud and when to tip off us as management. That's really why you're training, because it lets other people know how to be your policing system. And number 6, put your picture there. You have got to be the person who oversees this business. In almost every case of fraud we see, one of the primary weaknesses is a lack of oversight by the executives, especially by the owners. And for us, that's what allowed Doug's fraud to continue for 18 months before an external source told us. Of course, in my case, Doug used my identity, the identity of John Sileo. So it was me who faced a criminal trial, me who lost the money. It appeared that I had committed the fraud. And there's no better reason for you to maintain strict oversight of your business than the prospect of years in jail, which I faced. Some common forms of oversight, I'm going to go through these very quickly, and again, we'll get these. One that I really like, besides monitoring reports, is open mail yourself. Open your mail. A fraudster generally uses the mail to commit the fraud. Open that mail, all of it, yourself. Have someone else check your work, and meet with employees one-on-one to detect the warning signs. Finally, what we didn't do, about midway through the process, we didn't trust our instincts when I should have, and that's when we had the final stage, which is separation. This is the point at which it all falls apart. You have to go your separate ways. It's never as easy as it would seem because that person's been in a position of power. I mean, Doug was in a position of power, and the problems that we have here, Doug had embezzled $300,000 from our clients, and he'd used my identity to do it. You don't just unwind that. And the fifth secret is don't let your emotions get in the way. They can quickly sabotage recovery. Obviously, the first thing you want to do is to kill them, to confront them, and then to seek revenge. You can't do it. The first thing you need to do is become very methodical in about how you go about processing this, because your chances of recovering funds are minuscule. Most people, 75%, recover very little of their funds. Don't think you're going to get money back. Now, because we didn't have time to go through all of this, Deluxe asked me to write a white paper for all of you. Everybody on the call is going to get it. It goes through all of the things you need to know if you suspect fraud. So it gives you that methodology, that very methodical way of going about it. And to put it simply, it's about prioritization. You need to figure out what stage you're at, your emotional stage. Do you need to bring in experts? Do you need to protect your evidence? Do you need to evaluate your processes, or do you need to evolve beyond what this fraud has done with you?